Today we are going to discuss about equities demand and supply. Every market dynamics depends on its own demand and supply, and so are equities. In this year, we have seen very good demand in equities, aggregating to around 6 trillion. The demand was driven by mutual fund inflows, retail and HNIs inflows. Whereas even the supply is catching up very fast in this market, and supply in this year is likely to even surpass the demand of equities at around 7.5 trillion. So overall aggregate supply is likely to be around 7.5 trillion in this year. And supply is contributed by the fresh issue, which contributes around 37%. So every time whenever the valuation go up in the equity market, and there is very good demand into the equity market, the IPO market becomes very active. And this year is also the same phenomena which we have witnessed, wherein the overall IPOs have contributed around 37% of the overall supply. And then even promoter selling, foreign promoter selling has also aggravated, contributing around 40%. And the rest is contributed by secondary sale. So if we just take every aspect, as I said, that IPO market was very active this year, and almost like 319 companies have offered their shares into the primary market, aggregating to around 1.57 trillion of supply into the market. And because the demand was very good in the market, in the equities, the overall oversubscription in this year has almost been up to extent of 26 times. And there are almost like 151 IPOs have oversubscribed more than 100 times. So most of these IPOs were from SME space as well. So overall demand in the primary market aggregated to around 46 trillion as against the supply of around 1.8 trillion. So that kind of exuberance we have seen in the primary market in this year. So this is the highest supply we have seen in the primary market. And overall contribution of the new listing to the market cap is also increased to around 3%. The most encouraging part of the current supply was large caps and mid caps were active. So both contributed around 34% and 28% to the overall offerings. But the small caps were even more active because of the rally what we have seen in small cap stocks in the near past that led to overvaluation in these stocks, and therefore most of the promoters became very active offloading their offerings into the small cap space, and therefore overall small cap contribution in this year's IPO market was around 38%, which is highest ever. And the sectors which contributed to these offerings were capital goods, NBFCs, and healthcare. Apart from this, as I said, that whenever markets go up, the promoters tend to book the profits because even they know that the companies are trading much above their intrinsic value. And this has happened even in this rally. So even like we see in last 2 years, from September 22 to this year, overall promoter shareholding has come down from 44% to 39%. So most of the promoters have cashed out on their profits. And overall, the promoter selling, it has increased from 1.5 trillion to 1.2 trillion to 1.8 trillion on year-on-year basis, which is almost like 50% increase on year-on-year basis. So this is largely driven by the market rally, the overall demand being very high in the secondary market, and therefore promoters selling their stakes at a good valuation. Also, QIPs were very active in this year. If we see for any promoter, there are two types of fundings which are available. One is equity funding, and one is like borrowings, debt. Whenever the market go up, the cost of equity tend to fall because the valuation increase, and therefore it becomes lucrative for any promoter to fund its capex from the primary market, from the equities, rather than depending on the debt where it has a fixed cost. So this has happened. This has happened in this market also, and therefore QIPs were very active. So almost 91 companies have offered their shares in QIPs this year, aggregating to around 1.3 trillion. This was more than doubled of 0.53 trillion, which was raised last year. And most of the capex intensive sectors like autos, metals, capital goods, so they were active in the QIP market because they tend to garner money for their future capex through QIPs. And this was one of the important supply which remained very active in this year. So, like overall, if we see, although the demand was high in the market, but even supply caught up very fast, and it is likely to continue if valuation remain at the current level, what we are seeing. The demand was largely driven by the domestic market. The domestic institution flows into the market. Those were highest ever. Whereas FI were net seller in the current market, the because of the attractive valuation elsewhere in the world, as Indian equities remain very overvalued, and that is likely to remain scenario at least in the near term, unless the valuation come down to a very attractive level as compared to the world market. However, DIs still remain very active into the market. At least we are seeing the moment continuing in the domestic flows. But going forward, what will drive the market is largely the earnings. Because if we see in any market, it depends on the earnings growth. So post-COVID, the overall earnings growth aggravated in the Indian equities. This was driven by the capital expenditure by the government. Also, the demand, overall demand improved in the overall economy. Exports also become very attractive. Export increased substantially during this period that led to overall earnings of the companies going up. That led to the re-rating of the companies, and therefore we have seen the rally in the equity market. Now, what is happening is on the high base of the last year, the overall earnings growth is moderating. So, in last 2 quarters result, if we see, the earnings have moderated for most of the companies. And although there are some green shoots seen in terms of capex picking up or the demand improving, because the base is so high, the overall growth is likely to remain moderate, at least in the near term. So that will drive the overall market moment, which we feel that there could be some consolidation in the market going forward. And this is also, supported by the fact that the PE ratios. So if we see that the PE ratios for the small cap and mid cap companies, they remain still at a elevated level above their long-term averages. So mid cap companies, the PE remain at a much above their long-term averages. That shows that if there is any disappointment in the earnings, there could be sharp derating in these P ratios. And similarly for small caps, it also remains above their long-term average. However, for the large caps, the P ratios remain at least in the range of their long-term averages. That shows that exuberance is less for the large caps. So just to summarize that, although not every sector or every company will be at that exuberant level, but there will be some pockets of sectors or companies which are discounting much higher growth than what they will be posting, or at least in the near term. So if there is any disappointment on those kind of growth numbers, we will see some kind of moderation in the pricing and valuation. So at Quantum, how we are taking over this approach overall. So the Quantum Small Cap Fund, so we are positioned very attractively in the current market, wherein we hold some cash to get to encash the opportunity the market will be throwing over a period of time. And also, when the overall portfolio construction approach is seen, we are not exposed to very overvalued sector, and the exuberant sector where we are seeing that frothiness. So some of the sectors like cap goods and industrials, they we feel that they are discounting much more the growth than what actually the company can offer over a period of time. So therefore, our exposure to those sectors is limited. But there are some sectors like BFSI, healthcare, or consumption, insurance for that matter, where we feel that the valuations are attractive and the earnings are sustainable. So for us, the sustainability of earnings, good cash flows, good management are something which we focus on, and we build our positioning based on that. So that has benefited us in the market turmoil, wherein the quantum small cap fund has fallen much lower than the index, and therefore capital preservation is key. Apart from that, whenever the market offers an opportunity, we are very prompt in encashing onto that and getting onto the companies where we see the sustainability of earnings with good cash flows and good managements. And therefore, overall construct remains very focused, and there we expect to serve you better with that strategy. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.